For years, crypto felt like the Wild West. Anonymous founders with anime profile pictures. Exchanges that appeared overnight and disappeared even faster. White papers that promised to revolutionize finance but couldn't explain how they made money. It was chaotic. It was thrilling. And for many people, it was expensive. Billions vanished in hacks. Platforms froze withdrawals. Retail investors learned the hard way that not your keys, not your coins wasn't just a meme. It was survival advice. Back then, crypto wasn't a financial system. It was a frontier. And frontiers attract pioneers, but they also attract outlaws. Now, fast forward to early 2026. The total crypto market value has touched $4 trillion. Let that sink in. Not meme-driven hype, not pandemic stimulus-fueled speculation, but a structurally different market, one shifting from chaos to compliance, from hype to fundamentals. Bitcoin swings, yes. It recently surged toward $126,000 before pulling back. Volatility hasn't vanished, but something else has. The existential fear. The fear that the exchange holding your assets might evaporate tomorrow. The fear that regulators would shut everything down overnight. The fear that crypto would forever remain financial anarchy. Because here's what most people haven't fully processed yet. Crypto grew up. It moved out of its parents' basement. It stopped spray painting slogans about decentralization on the wall and started filing compliance reports. In 2026, crypto doesn't look like a rebellious teenager anymore. It looks like a regulated financial instrument sitting right next to stocks, bonds, and ETFs inside diversified portfolios. The Wild West is over, and what replaced it isn't boring. It's powerful. Governments didn't kill crypto. They domesticated it. And ironically, that may be the most bullish development in the entire history of digital assets. The question today isn't whether crypto survived regulation. It's whether regulation is the very thing that made it inevitable.
If you're asked where crypto truly grew up, look at the United States. Not long ago, operating a crypto platform in the US felt like navigating a legal maze. Guidance was fragmented. Enforcement was inconsistent. Many early platforms ran light-touch operations, minimal identity verification, loose oversight, and aggressive marketing. That era is over. By 2026, leading US exchanges such as Coinbase, Kraken, and Gemini operate under strict federal and state-level oversight, including compliance with the SEC, FINRA, and state money transmitter licenses. This isn't symbolic. It means strict anti-money laundering compliance. It means transaction monitoring. It means full reporting to regulators. It means accountability. Most importantly, it means serious KYC. Opening a crypto account today isn't just uploading a passport photo anymore. You're recording live selfies with liveness detection, submitting proof of US residency, and linking your bank account for verification. Geolocation and IP checks confirm your physical presence. Penny drop verification ensures your bank account ownership before any significant transfer. This isn't the Wild West. This is a regulated financial rail, and it's designed to allow large investors, retirement funds, and institutional capital to participate safely. The US market sends a clear signal. Crypto isn't being outlawed, it's being integrated. Integration is what makes a $4 trillion asset class sustainable, not anonymity.
The US isn't acting alone. Regulation is now a coordinated global trend, but let's start with American milestones. The SEC's approval of regulated Bitcoin ETFs was a turning point. For the first time, retirement accounts, pension funds, and wealth managers could allocate to crypto without holding private keys.
Structured disclosure requirements ensure investors know exactly what they are buying. Meanwhile, state-level regulators, from New York's Department of Financial Services to California's Money Transmission Division, require exchanges to implement strict custody, reporting, and auditing standards. Anonymity tools or unvetted tokens face barriers to entry, reducing operational risk dramatically. Zoom out globally, and the picture is similar. The CFTC oversees crypto derivatives and futures, ensuring market integrity and protecting investors. Canada and Singapore have implemented licensing frameworks for exchanges and token offerings, signaling that regulated crypto is a global standard. The pattern is clear. Jurisdictions that define boundaries stabilize the market. Chaos may have fueled early excitement, but trillions in capital won't flow into systems lacking transparency. For American investors, this is a confidence booster. Volatility remains, but structural fragility is gone. Fear of losing everything to a hack or unregulated platform is shrinking. The Wild West is fading, and a regulated mainstream crypto market has emerged.
Here's the irony no one predicted in 2017. The very force crypto once feared most, regulation, has become its biggest growth catalyst. Because once the rulebook is written, institutions can finally step onto the field. For over a decade, large financial players watched from the sidelines. Asset managers, pension funds, insurance companies. They saw the upside, but they couldn't justify the reputational and compliance risks. Now they can. When exchanges are registered, when reporting standards exist, when custody rules are clear, when tax treatment is defined, crypto stops being a gamble. It becomes an asset class. And asset classes fit into models. Portfolio managers don't ask, is this rebellious? They ask, how does this correlate with equities? What's the Sharpe ratio? What's the drawdown profile? That shift in framing is massive, because once crypto enters portfolio optimization software alongside stocks and bonds, it stops being an outsider. It becomes allocation. And allocation is systematic. We've already seen the ripple effects. Regulated ETFs tracking Bitcoin and Ethereum opened the door for retirement accounts to gain exposure without touching private keys. Futures markets deepened liquidity. Custody providers now operate under banking-level security standards. In other words, crypto didn't lose its edge. It gained infrastructure. And infrastructure builds confidence. Confidence attracts capital. Capital deepens liquidity. Liquidity reduces volatility over time. That's how markets mature. This doesn't mean price swings are gone. Bitcoin recently surged towards $126,000 and pulled back sharply. Volatility is still part of crypto's DNA. But there's a critical distinction in 2026. Price risk remains. Platform risk is shrinking. The risk of an exchange vanishing overnight, dramatically reduced. The risk of pure scam tokens flooding regulated platforms, filtered. The risk of unclear tax treatment, clarified. Regulation hasn't removed speculation, it has removed structural fragility. And once structural fragility declines, capital scales. Crypto isn't fighting the financial system anymore, it's plugging into it. And when that happens, the ceiling changes.
Think of crypto like a teenager. In 2013, it was rebellious. In 2017, it was loud. In 2021, it threw the biggest house party the financial world had ever seen. And by 2023, it got grounded. Scandals, collapses, lawsuits, the kind of chaos that forces maturity. Fast forward to 2026, crypto didn't disappear. It graduated. It put on a suit. It showed up to the boardroom. Major financial institutions that once dismissed digital assets are now integrating them into diversified portfolios, not as speculation, but as strategic exposure. Why? Because once regulation defined the playing field, crypto became measurable. It became auditable. It became insurable. Institutional custody providers now operate with multi-layered cold storage systems, insurance coverage, and real-time compliance reporting. Risk committees that once blocked crypto exposure now have documented frameworks for allocation. This is what adulting looks like in financial markets. You don't get to skip rules when you scale. You adopt them. And the adoption has created something powerful: standardization. Standardized disclosures, standardized accounting treatment, standardized reporting, standardized onboarding. When an asset becomes standardized, it becomes easier to analyze. And when it becomes easier to analyze, capital flows more confidently. We're no longer debating whether crypto should exist. We're debating how much of it belongs in a portfolio. That's a fundamentally different conversation. Even wealth managers who once warned clients to avoid digital tokens at all costs now discuss allocation percentages: 1%, 3%, maybe 5% depending on risk tolerance. The narrative shift is subtle but profound. Crypto isn't an ideology anymore. It's a tool. And tools are judged by utility, not emotion. The rebellious phase served its purpose. It proved the technology worked. It proved demand existed. But maturity is what unlocks scale. In 2026, crypto doesn't feel like a fringe experiment. It feels like an emerging pillar of modern finance. And pillars don't stand on hype.
Let's be honest. When most people said crypto was risky, they weren't really talking about volatility. They were talking about losing everything. Not because the price dropped, but because the platform collapsed. There's a huge psychological difference between a 30% drawdown and waking up to find withdrawals permanently disabled. That second fear defined crypto's first decade. Exchanges with opaque balance sheets, founders operating from unknown jurisdictions, customer funds commingled with operational capital. It wasn't just speculative risk, it was structural risk. And structural risk is what keeps serious money away. But in 2026, that specific risk is being systematically erased. When exchanges register with financial authorities, they face capital requirements. They undergo audits. They implement segregated custody. They file suspicious activity reports. They maintain transaction logs. The oversight isn't theoretical. It's active. Governments aren't hovering in the background anymore. They're embedded in the reporting infrastructure. And that changes behavior. A regulated exchange executive in 2026 doesn't operate like an anonymous founder in 2018. They operate like a bank executive. Reputational risk matters. Licenses matter. Compliance officers have veto power. Now, does this eliminate price swings? No. Bitcoin can still surge toward $126,000 and retrace sharply. Altcoins can still experience brutal cycles. But volatility is market risk. Fraud is operational risk. Market risk is expected. Operational collapse is catastrophic. By shrinking operational collapse risk, regulators are reshaping how investors perceive crypto, and perception drives participation. When you remove the fear of total wipeout through fraud or platform failure, crypto shifts categories in the public mind, from casino chip to high volatility asset. That's a meaningful upgrade. Think about traditional equities. Stocks crash, companies fail, but you don't worry about your brokerage evaporating overnight because it's regulated. Crypto is moving into that same psychological territory. The fear of chaos is fading, and when fear fades, allocation rises. This is what maturity looks like. Not the disappearance of risk, but the refinement of it. There was a time when crypto conversations felt philosophical. Down with banks, escape the system, financial revolution. It was ideological energy.
And ideology is powerful in the early stages of a movement. But ideology doesn't scale to trillions. Infrastructure does. In 2026, crypto's narrative has shifted from rebellion to integration. Instead of asking how to replace banks, firms are asking how to interoperate with them. Payment rails are integrating stablecoins. Asset managers are packaging digital exposure into regulated vehicles. Accounting standards now define how digital assets sit on corporate balance sheets. This isn't anti-establishment energy anymore. It's institutional plumbing. And plumbing is what makes modern finance function. Look at the onboarding experience today. High-resolution biometric scans, two-factor authentication, bank-linked funding verification, automated tax reporting. It mirrors traditional finance because it's converging with it. The early adopters who prized anonymity above all else might see this as compromise, but from a systems perspective, it's evolution. Because if crypto remained purely permissionless and opaque, it would remain niche. Niche markets don't reach $4 trillion sustainably. Mainstream markets do. And mainstream markets require rules. The paradox is this. By accepting oversight, crypto preserved itself. Had governments chosen prohibition instead of regulation, capital would have retreated into the shadows, fragmented, inefficient, fragile. Instead, major jurisdictions chose structured integration, and integration compounds. Once exchanges operate legally, banks partner with them. Once banks partner, payment providers connect. Once payments connect, corporate adoption follows. This is how asset classes mature. They stop fighting the system and start reinforcing it. Crypto hasn't lost its technological innovation. Blockchain rails still operate. Decentralized protocols still exist. But the bridge between decentralized innovation and regulated finance is now engineered, not improvised. The Wild West wasn't sustainable forever. Every frontier eventually builds roads. Crypto builds highways. So here we are. Crypto in 2026 isn't the Wild West anymore. It's not anonymous founders launching tokens from unknown jurisdictions. It's not exchanges operating in legal gray zones. It's not a financial free-for-all driven purely by hype. It's regulated, it's audited, it's integrated. It grew up. And that maturity changes the central question. For years, people asked, is crypto safe? In the early days, that was a fair question. But today, the real question is different. Are you ready to treat crypto like what it has become? A regulated financial tool. Not a lottery ticket, not an ideology, not a rebellion. A tool. Volatility still exists. Bitcoin can swing dramatically. Markets will cycle. Speculation will never disappear entirely. But the existential fear, the fear of platforms vanishing overnight, of total collapse through fraud, is being systematically reduced through oversight, compliance, and transparency. Regulation didn't suffocate crypto. It standardized it. And standardization invites participation. Stocks have rules. Bonds have rules. Commodities have rules. Now crypto has rules too. And once an asset class has rules, institutions allocate to it. Retirement accounts included. Wealth managers model it. The Wild West era created excitement. The regulated era creates durability. Crypto isn't a gamble for the tech-savvy few anymore. It's a maturing component of modern portfolios. The frontier is over. The foundation is built. The only question left is simple. Are you going to watch this asset class mature from the sidelines, or are you ready to diversify?